Hello and welcome. You're watching News 9. The Indian markets continue to remain under pressure today. Their fourth consecutive session of losses. At close, the Sensex was down 0.58% to close below the 58,000 mark, and the Nifty was down about 0.65% to close above its psychological support of 17,000. The bloodbath continued in the broader markets, with Nifty Mid-Cap 100 falling about 0.52% and Nifty Small Cap 100 down by about 0.83%. Among the top losers on Nifty was Adani Enterprises, which fell over 7%, and Adani Ports, which declined about 4%. Mahindra & Mahindra, Bajaj Finance and TCS were some of the other stocks that fell the most in today's session. Among the winners were BPCL, Titan and Bharti Airtel. All of them ended the session about 1% higher. Shifting focus to sectors now, all sectoral indices, barring Nifty Media and Nifty Pharma, ended the day in red. PSU Bank counters were the top losers, falling about 2%, followed by IT stocks, which fell over 1.5%. Joining me in the newsroom at this moment is my colleague, and Suyash is here with me. Suyash, over to you. The markets look better, but as we rightly said, they've continued to remain under pressure today as well.
Yes. Let me welcome to the show CA Lalit Shah and CA Shweta Kothari, who will provide us with valuable insights on what transpired in the market today and what you can expect from tomorrow's session. Sharath, the markets have been on a decline for 4 straight sessions now. What do you think is the overall sentiment for the retail investors?
Well, I think retail investors are a bit of a worried lot at this point of time because the market was so volatile today. I mean, it started on a flattish note, and then it went down, then it went up again, it closed down. So I think the retail investors are preferring to keep away. Although as an advisor, I am advising them personally to use these dips to probably buy in smaller lots, the SIP, as they say, not the SIP of the mutual funds, but SIP as a method of investment. So we've been recommending them to buy in smaller lots, divided by, let's say, weeks or fortnights, and then invest in smaller lots. But overall, I think the retail investors are a bit confused. They are a bit scared as well. The American banking crisis and the failure of the American banks are scaring the investors away. And let's not forget, just before that, the Adani storm was there, and even that had not finished, and we had this banking crisis. So it's been a bit of a tricky ride for the retail investors, and they are a worried lot. And most of the investors that I spoke to on the retail front, they prefer to keep away. But there are some of the retail investors who also walk into the derivative section. You come as an investor and you start trading in the derivatives, the futures and the options. And in futures and options, there's a general rule which says there's no upside or downside. There is only one side, which is right side. So they, some of them try their hand in a falling market as well. But when the market becomes so volatile, it's very difficult to catch the trade, catch the bottom, catch the top at this point. So I think overall, it's a very tricky market. And sometimes, we recommend that probably keeping away from the market or not trading is also a strategy. So this is one of those times, I would like to say.
So, Sharad, despite today's decline, Nifty still managed to defend the crucial psychological level of 17,000. What do you think are the near-term support and resistance level for the benchmark?
Well, I think 17,050 to my mind was the support, and the market during intraday. Let's not forget, intraday it breached 17,000. It went down, then it came up, and then it recovered a bit. So I think the 17,050 has pretty much been breached, and positive news coming from the US. So let's not forget, this is all imported mandi, as we call it. This is all the news flowing in from America, the Silicon Valley Bank and the Signature Bank and so on and so forth. So that is what is causing the sentiments to go down. But then I think if it breaches 17,000, we can easily see the market. We should not forget that the last market support was 15,200. We saw that last year. From there, it recovered and went up to 18,400. I'm talking of the Nifty. We mostly analyze Nifty because Nifty itself is traded. So I think if it goes below 17 in the sessions to come, let's hope, wish and pray it doesn't happen. But if it happens, then it just might have a free fall down to 16,000 or even below. That's what my take is. But I hope it doesn't happen.
Lalit, welcome to the show. What's your take on this?
Yeah, hi Shreyansh.
Hello.
Hello, can you hear?
Yes. So, Lalit, my question to you is, what do you think is the near-term support and resistance level for Nifty?
See, today Nifty touched its support of 17,000 and it came back sharply. But let's not forget that again it can go back to below 17,000, and once it breaks 17,000, then the next support is at around 16,800 and 16,500. I am talking about the weekly supports, not the longer term supports like Sharad Bhai told that if it breaks that, then 50, we should not forget that 15 to 200 was the lower level support. So the immediate support, I think, right now investors should look at is 16,800, where one should start accumulating their shares, shares in power sector like NTPC. I'm very bullish in this sector, power sector. So one can start looking at investing at around 16,800. But let's wait. We should not be in a hurry to buy because, as Sharad Bhai already told, that there are many things. Recession is going on in America and Europe, European countries, and you can see that the major banking shares are falling right now due to the factor you have seen in America. So we should wait and let the market consolidate here, and then we should start doing. And the best investing strategy is the SIP strategy, which already Sharad Bhai told. So I totally agree with Sharad Bhai. Yeah, Sharad Bhai, asking something?
No, 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 I'm not asking something. I just wanted to add to your comments with the permission of the anchor that, sometimes the market goes through a phase where, there are two kinds of analysis. We do the technical analysis where we read the support levels, the put call ratio and so forth. And there is a fundamental flow of news. So sometimes, there are phases in the market when the fundamentals or the news which flows in, it overrides the technicals. So then what happens is that the technicals become a little faded, they become a bit diluted. So I feel this is I think Lalit would agree with me. This is one of those times when, this news flow overrides the technical. So then, although we have support levels, we have resistance levels, as you rightly said, 16,800, 16,500. And then if it goes down, we knew it went down to 15,200. But if the news flow is overriding and the fundamentals, when I say fundamentals, I mean the bad fundamentals of the American banking sector for that matter, fundamentals override, then sometimes, the technicals tend to fade away and the technical lose their relevance to a certain extent. Lalit bhai, I hope you agree with what I'm saying.
Yeah, yeah. Yes, Sharad Bhai. Yes, yes. Absolutely, absolutely. Yeah, one thing one should look at is we cannot predict the lower end of the market and we cannot predict the higher end of the market. So best strategy for retail investors here is the SIP option, which we and Sharad Bhai already has discussed, that we should start investing not full amount, but little amount at every level of support of Nifty. And we should wait for the market. And I think the majorly we can say people should not be in a hurry to invest here. That's the basic line.
So, Lalit, as you were talking about the banking stocks being in focus, since the collapse of Silicon Valley Bank, what's your outlook on Bank Nifty?
See, there are many other things in which bank are already dealing. We have seen the Adani matter also, in which PSU banks, majorly SBI, Bank of Baroda, and PNB, they have lended hugely to Adani Group also. So that is also their pressure. How Adani looks, when we see that Adani gets the support at downside, so banks also will get the support there when Adani Group will start picking up. Then banking stocks will shall start picking up. But I will say right now it is one should be stay away from Adani shares and little bit of the banking shares till the news flow is not positive in this sector.
Sharad, your take on this?
Well, I think Bank Nifty, if you see today's trade, Bank Nifty has relatively speaking performed better. If you compare it with Nifty and compare it with some, let's say Nifty IT, and you compare with some of, we today had the Nifty, the Fin Nifty expiry also, which happens on Tuesday. So Bank Nifty did a tad better than the rest of the thing. So I think the banking shares were already being hammered for the last few days because after all, the whole story was about banks only. I mean, the story started from bank and the story is yet to end on a bank. So obviously the banking sentiment or sentiment with regard to the banking sector was a bit depressed. But today, surprisingly, we saw some kind of resistance building up in the banking sector. And the bank Nifty, as I said, didn't do as bad as the Nifty did. So maybe, in bank Nifty may have been bottomed out. And we should not forget, the investors should not forget. I'll also give you a fundamental view that the Indian banks are not impacted. Of course, as Lalit rightly mentioned, because of Adani, the banks have taken a hit, and they've already taken a hit in the last few weeks, shall I say. But then now I think they probably have bottomed out, and this news from the banking sector in America has got nothing to do. We should clarify to the News 9 viewers that this has got nothing to do with the Indian banking sector. Well, or these startups may have been banking with those banks, but Indian banking sector is in safe hands. Reserve Bank of India has got a very strong monetary mechanism. And I think that is counting on the market sentiment now. So the bank Nifty may just be a better performer than the other Nifties going forward.
As we are talking about sectors, so all the sectoral indices were under pressure today. So Sharad, where do you see an opportunity for retail investors, and what sectors are ones that one should avoid?
I think I see an opportunity, although this might sound a bit out of the box, and it might sound a bit ironical as well. I see an opportunity in the IT sector, although because of Silicon Valley coming from the tech world and Silicon Valley being directly related to the tech world, the startups. But we should not forget that the established IT companies like Infosys, like TCS, they have come under heavy beating. So I think some of the valuations there have become very attractive. Then I support what Lalit said, the power sector. I support the defense sector. FMCG is one sector where I like to put my bets. These are some of the sectors I feel which are likely to do well in the times to come. But then the method of investment, I would like to reiterate here, the method of investment should be SIP. Investors should not get carried away, take out their entire kitty and just go for a low valuation stock that the price has become very attractive. They should not do it because the market is still on a fall. I think it sounds like a bear market right now, but may not be. You never know. One good news coming from America where President Biden comes out, or Jerome Powell comes out and says, hey, look, man, all the depositors have been paid. Everything is hunky-dory. And you might see the market turning around. So I think it is an opportune time to look for low valuation stocks, very attractive valuations. Some of the stocks have got very attractive valuations. So IT, FMCG, defense, power, these are my bets for now, but very strictly in SIP format.
Lalit, I have the same question for you. Where is the opportunity for retail investors, and what should one avoid?
Yeah, as I already said, the power sector is already I'm seeing, and especially the NTPC type shares, which are safe also to invest for the retail investors. And the other sector, defense, is also very good. And one sector I should mention is the capital goods sector, like shares like L&T. One should accumulate these heavyweight shares where they have a very good order book all around the world. They are doing good business. So irrespective of whatever the things go forward, like the recession, or we are talking about the American banks or everything, but we have seen from Corona also, when the market was falling, ultimately it came back, right? So Indian story is very good. So investors should not fear to invest. But as Sharad Bhai said, that investment should be in SIP form only, whether you are buying any power sector, or you are into any banking sector, or you are in capital goods sector. So these are my picks. And yes, of course, Infosys, TCS, any day investors can accumulate, because till the growth story is intact in India. And I should tell you that this phase will go, and we will regret that at these levels, why we didn't invested in shares like Infosys and TCS when they were so cheaply available. So we should try to invest in SIP mode here. And one thing I should add here, Shreyans, that you might ask me also, that weekly expiry, regarding the weekly expiry, I want to say one thing, that today I have seen that in Nifty at around 17,200, there is a major call writing happening, right? So one should avoid the position till Nifty is not going above 17,200 to buy the Nifty. Just wait and watch. 17,000 to 17,200 are the major levels of Nifty for this weekly expiry. Once it breaks 17,000, then 16,800 becomes active, the next target. And if it breaks 17,200, then the next major resistance is around 17,400. For weekly expiry, 17,000 to 17,200 is a major resistance and support zone for Nifty. So any fall below 17,000, it will take to 16,800 and 16,500. And anything above, like Sharad Bhai said, any one good news, if Nifty goes beyond 17 to 220 to 40 level, then it can go to 400 and 500 level. So before investing in index, one should note these levels for weekly expiry, especially in Nifty. Yes, Shiraz.
Thank you for joining, Sharad. Thank you for joining, Lalit. Over to you, Shweta.
All right, Suyash, thanks very much for joining us with all those details. Shifting focus now, chaos took over the startup world when tech industry's most prestigious bank collapsed, sparking a wave of panic. The Silicon Valley Bank ended its 40-year run last week when the regulators seized SVB's deposits in the largest US banking failure since the 2008 financial crisis. What exactly led to the bank collapse and what will be its repercussions in India? For that and more, my colleague Amit Ranjan is joining us in the studio. Also joining us very, very shortly is Yogendra Kapoor, economist and banking expert. But before we go to Yogendra, let me come to you, Amit. Explain to us what happened with SVB. What is the extent of the damage caused by the SVB collapse?
Thank you, Shweta. You've given the numbers. Now I'll just dumb it down. At the basic level, SVB, Silicon Valley Bank, caters to the tech industry, which is concentrated in California. When the pandemic came, there was a speculative boom, and venture capitalists were plowing tons and tons of money into tech. That was the sunrise industry, or the industry that was doing the best in those days. Now these tech companies were putting that money into just one big bank, that was SVB. Let's be clear, we live in an insular world where there is an information superhighway, but we have these closed groups in social media. And one of the things that triggered off the panic was that what SVB did was, instead of plowing this money back into the market, it put the money into government-backed fixed-rate debt securities. This made it vulnerable to interest rates. When interest rates rose, that means less money was being plowed back into the market. Less money was being plowed back into the market, which means there was less money even for new tech startups. That was one of the reasons that probably triggered a little bit of a panic that SVB does not have money to lend. And that is when all these big companies came back looking for their money. Now, SVB had this, like any other bank, dwells on the prisoner's dilemma, that I have all the money to give you back as long as you don't want it at one time. But if you want it at one time, there's a problem, and that is what triggered the SVB collapse. Just to put it in a very big nutshell.
Yes, and you know, this has actually affected banks all across the world, and particularly also in India. Amit, I want to understand the extent of the damage here in India, because startup founders are really worried.
Okay, I'll start with Asian markets. Japan's biggest bank dropped, the index dropped 7.4%. It's worst in 3 years.
Okay.
That is the Japan's Topix Banks Index, while the Topix itself dropped only 2.7%. Asian stocks today were dragged down by banks. South Korea's Kospi was down 1.9%, Hang Seng was down 2.3%, China's CSI declined 0.6%. Now we come to India. Now, India, because of Indian banks' reliance on local deposits, we do believe that we are cushioned against things that are happening outside India. And despite all the doom and gloom in global banks, there's hardly any exposure amongst Indian banks towards the SVB. There is some, but not too much. But there's a question of sentiment. So it is probably that just when the Indian stock market seemed to be recovering from the Adani aftermath, investors have turned poorer by 7.3 lakh crores in the last 3 sessions. So that is how much it has affected India.
Okay.
It is periodical in the sense it may not last, because there are other factors, because SVB does not have much exposure in India, but the immediate ripple effect has been that much.
Okay, so what you're saying essentially is that it's sentimental.
Yes.
There may not be much impact on the ground. Let's get a perspective from Yogendra Kapoor. He's joined us just now. So thanks very much for speaking to News 9. I want to understand the extent of the damage that will be caused by SVB bank collapse in India. And we are obviously, looking at and reading about the banking stocks that have collapsed around the world.
See, at the outset, I can say that the impact of whatever has happened in SVB is not going to be that significant in India. The primary reason being that I feel that since the last decade or so, I have been sensing that, the banks have become quite stringent on two parameters quite strictly, which is the due diligence part and the risk assessment part. And one must understand that these are very, very primary things which need to be undertaken on a real time and regular basis.
Okay, I think we have lost Mr. Kapoor there. Amit, coming back to you, it was an interesting point you mentioned. You said this is more sentimental and not likely to have an impact on Indian banks. What about Indian startups? Because there's a lot of exposure of Indian startups as far as, SVB is concerned.
Well, what happened with the learnings, I can say now, what has happened to startups, the exposure is there, but it is limited.
Okay.
To two figures of the number of companies.
Right.
Not what happened in America. The learning that I can talk about is you don't put all your money in one bank. I mean, there was a streaming giant called Roku which had over 500 million in just SVB. If you hedge it, and SVB, one bank takes a decision to put it in low return securities, then that decision may not be replicated by other banks, so you're sorted. But if with SVB, most of these companies, because they grew together, they relied on SVB. Has some to do with social media and closed groups because they dwelt on each other. But if they had put their funds in different places, this situation may not have happened. So that is one learning for startups.
And I think that's a very important learning, Amit, as far as startups is concerned. But I think Mr. Kapoor is back with us. Mr. Kapoor, I want to ask you, we have sharp suits who want capitalism on the way up, but socialism on the way down. Isn't it high time that bankers shed this line of thinking?
You see, we are moving in a new world where we are sensing emerging new fields, whether it is crypto, whether it is digital technology. So it's becoming all the more very important that two parameters, which is the due diligence part as well as the risk assessment part, needs to be taken by the banks on a regular and consistent basis. Because you see, at the end of the day, it is the credibility of the institution that is at stake. We are already sensing and seeing that, in case you tend to, compromise on these processes is what we are seeing that has resulted in Silicon Valley Bank. Now here, I specifically feel that it is not only the systemic failure, it is also the strategic and operational failures of the management of the bank as well. Now, you see a situation that the Fed rates are increasing. You have already invested in long-term in treasury bonds. It is at this moment that's very important that that you need to be reassessing your strategies from time to time, because if you want to avoid a situation the way it has happened in SVB, it's very important that these things need to be taken care of on a real-time basis. Otherwise, you see, it's the credibility of the bank, credibility of the rating agency. Here, in this case, Moody's have stick to their A rating to SVB. Now, this in itself reflects that what kind of risk assessments is being done by these credit rating agencies as well on a real time and regular basis. So I think we are already witnessing that India is moving towards privatization and on PPP model. and moving away from the socialist part as you started with. So it's all the more very important that at every stage you need to be assessing the risk on a real time and regular basis.
Okay. The need to assess the risk at real-time basis. That's the message coming in. Amit, I think you wanted to add something. We were talking about the exposure to startups.
Startups, yeah. Now, tech companies and startups live and die on their ability to raise money from VCs. VCs put in money because they see a return. These fundraising rounds happen every 1 or 2 years. What could be a learning from this and could be a change that could be effected is that if all the money is not given to startups at one point, but a credit line is extended as and when they need the money.
In tranches, basically.
In tranches, then these sorts of situations can be avoided. That if you have a large chunk of money, a startup has a large chunk of money, it has to put it somewhere, so it puts it in one bank because it can't spend it at one point. That bank does something with the money, and that is where the problem starts.
Okay. Mr. Kapoor, what is the contagion fear spreading? How can Indian startups ensure that they are not engulfed by the fear? Because right now we are seeing a lot of panic on social media as well.
Definitely. You see, I think we are all witness to this fact that the pace at which this virus spreads through social media is really enormous. And I think it's a situation of panic which needs to be understood. But then I think it is the step-by-step approach that is very important as to how, we move from here. Now, we already see that in the United States, the Federal Bank has taken over the control of SVB. And now this is how you need to ensure that at least the money of the depositors is safe. Whose money is at stake is definitely of the shareholders who are expecting to encash on the brand valuation. So the point to learn is that, as the fellow panelist rightly said, it's very important that you should not be giving in the money at one go, and it's important that you should be giving it in tranches so that you are able to see how the new venture is taking shape. And if at all, one can also ensure that you are backed by adequate collaterals. Then I think that is where, it's a line that is drawn by the bankers to ensure that at least their basic capital is safe.
Okay. Before we wind up, I have one last question for both of you. To you first, Mr. Kapoor. This comes close on the heels of the fact that there is a funding winter and Indian startups are jittery at the moment. How can startups really tackle this setback?
See, what I'll say is that one needs to understand that whenever you are entering into, a new emerging activity, it's always a question of timing, and it's very important that one should also see that whatever activity you are engaged in is being promoted in the right perspective within the society. I like to quote an example. Now, the point is the rise of cryptocurrency in India. It has been backed in both manner. It had been, if you look into the history, it was banned by this Supreme Court of India, Reserve Bank of India had been quite stringent on that. But I mean, it just, in fact, created a kind of imbalance. So the point is that whenever we are talking of any startup, it's very important that it should be promoted on in a phased manner, just like we do in infrastructure construction activity, wherein the funds are being.
Okay, I think we've lost Mr. Kapoor there. Amit, with SVB's collapse, Indian startups are likely to lose a major support system in the US. How do they manage? How do they tackle this setback?
Well, the talks of the funding winter had started way before the SVB crisis even took shape. So it will just add one more cog into this snowballing of this funding winter, so to say. But the lessons are there to learn. It is there may be a change in the regulation. There may be a change in the way startups approach their businesses. In India, we are like we say, we are less affected. But again, it's a question of sentiment, so that will snowball. But in India, I don't see anything beyond that. The startup industry, the tech industry as it is going in the midst of a shift, or a transition, so to say. They are restructuring, they are re-looking at their working models, hybrid and all that post-pandemic. So that is already happening even before SVB started. And it will continue to happen despite SVB. Money will become more scarce, but at least the learning for startups, I hope, is that they don't put their funds just in one bank from here on.
Okay, a whole lot of learning there from the SVB collapse. Yogendra Kapoor is also back with us. Mr. Kapoor, what is your learning takeaway from the collapse of SVB?
See, the major learning I would say for Indian banks is that they should be engaged in, the due diligence due diligence part as well as the risk assessment part on a regular basis, and the funding as such should not be strictly based only on the brand valuation. It has to be adequately backed with collaterals as well to ensure that, God forbid, if any project doesn't take place, their part of their capital is still ensured.
All right, Yogendra Kapoor, Amit Ranjan, thanks very much for joining us on this very important story. We will, of course, continue to track all developments as far as SVB Bank is concerned and its repercussions on India is concerned. But for now, shifting focus, the wholesale inflation eased to a 25-month low to 3.85% in February. India's wholesale price index-based inflation eased from 4.73% in January on the back of fall in prices of crude, petroleum, natural gas, non-food articles, food products, minerals, computer, electronics and optical products, among others. Inflation in pulses was recorded at 2.59%, while vegetable was at negative 21.53%. Inflation in oil seeds was negative 7.38% in February of 2023. The latest WPI numbers is favorable for corporates, as a dip in wholesale prices might ease pressure and lower input cost might also bode well for retail prices. The consumer price index-based retail inflation numbers that came out yesterday also have shown a marginal dip to 6.44% in February as against 6.52% in January, mainly on the account of a slight easing in prices of food and fuel items. The CPI inflation stayed above the Reserve Bank of India's upper tolerance level of 6% for the second straight month. And this is likely to prompt RBI to increase the borrowing cost once again to the highest level in the last 7 years. Another important story that we're tracking here, Bharti Airtel has increased its entry-level tariffs. As a result of the hike, the 99 rupees prepaid plan has been removed, leaving the 155 rupee plan as the only entry-level recharge option available across all 22 circles in India. The tariffs were hiked in the remaining 3 circles across India, that is Gujarat, Kolkata and Madhya Pradesh and Chhattisgarh as well. Now, this effectively means a pan-India tariff hike of approximately 56%. Now, while this step is expected to fetch some returns, it's not material for financials of Bharti. Morgan Stanley expects that this to be a 1.3 to 1.5% accretive to revenues of Bharti India's mobile business. The key triggers for the stock would be potential 4G tariff hikes and market share gains after a meaningful rollout of the 5G network. This according to Morgan Stanley. So prepaid plans, they're getting more expensive. Now, the buzz around NFTs has officially taken a back seat. Meta, the parent company of Instagram and Facebook, is winding its operation and integration of non-fungible tokens, NFTs, on its platform. Remember, Meta unveiled support for creators to share NFTs on Instagram and Facebook last year, when the crypto asset was the new hot talk around the globe. The NFT farewell means Meta will not only suspend its minting tests and selling NFTs on Instagram, but will also stop offering the share feature on both Instagram and Facebook in the coming weeks. Meta is shifting focus to impact at a greater scale now. Messaging, monetization on Reels and further improvement of services like Meta Pay will remain top priorities for Meta's future plans. The decision to pull plugs on NFT vertical comes as no surprise given that Meta has been taking the cost-cutting route for quite some time now. The tech giant laid off 11,000 employees, or about 13% of its global workforce, last year in November, marking the largest cut in the company's history. Following Meta's rebranding between October 21 to December 2022, the prices of Meta stocks slumped 60% from $323 per dollar to 114 for $114 for one stock, I beg your pardon. The stock somewhat managed to recover in the first quarter of 2023 and is currently priced at a $181. And with that, it's the end of this bulletin. Thanks very much for watching. Thanks to my colleagues Suyash and Amit for their valuable insights. We'll come back in just a bit.